Welcome to On Investors Minds. I'm Tai Hui, the Chief Market Strategist for Asia Pacific at JP Morgan Asset Management. And thank you for giving us a few minutes of your time to understand what investors are thinking about right now and how that fits in with building the right portfolio. So in this episode, we are going to explore our 2025 mid-year outlook, focusing on how to allocate investments in what we are calling a TUF environment. TUF, T-U-F, stands for trade policy, unintended consequences, and fiscal discipline. We will discuss what does that mean for US equities, global equities, fixed income, and also where to look for income. So let's dive in. Now, as we move into the second half of 2025, policy shifts from Washington are expected to continue to drive market performance and volatilities. We're focusing on three key areas: trade policy, unintended consequences from these policies, and also fiscal discipline, collectively known as TUF. Trade policy has been a hot topic, with US President Trump's reciprocal tariffs sparking negotiations with key trade partners. These negotiations are complicated and uncertain, not to mention some legal challenges facing the Trump administration. Meanwhile, on the fiscal policy side, the reconciliation bill is being worked through the Congress as we speak, highlighting a disconnect between lawmakers' lack of urgency to reduce fiscal deficits and concerns of investors and rating agencies over the sustainability of US federal debt. The Trump administration's policies, such as deregulations and foreign policies, could also have unintended consequences on the international economy and financial markets. Diversification is crucial to managing such risks, and steady income from a broad range of sources can help investors to navigate this TUF environment. So let's start with the economic picture. Will US growth exceptionalism continue in the second half of 2025? The outlook of the US economy depends on three cuts: tariff cuts, tax cuts, and Fed cuts. The US-China trade truce in May has reduced recession risks, but tariffs to US imports remain higher than they were at the end of 2024, posing challenges to supply chains, profit margins, and also the upside risk to inflation. Meanwhile, lower immigration and spending cuts can also hurt growth. The current fiscal bill offers growth with front-loaded tax cuts, and meanwhile, spending cuts are backloaded. This should help growth outlook for 2025 and 2026, but potentially risk high government bond yields as investors are concerned about fiscal sustainability, which could tighten financial conditions. In short, US economic growth is expected to slow, narrowly avoiding a near-term recession. However, long-term growth faces challenges from lower immigration, higher deficits, and modestly higher inflation, not to mention some of the unintended consequences from all the policies coming out from the White House. In China, tariff de-escalation suggests some easing in near-term growth pressure, and meanwhile we expect the government to continue to apply proactive monetary and fiscal policies, while Japan's economic recovery is likely to continue, supported by resilient domestic demand. So next, let's move on to central banks and also government policies. What are governments and central banks expected to do? We see varied policy response across different regions. For example, in Europe, the ECB is still on the path of easing monetary policy. We expect 1 to 2 more cuts this year. Meanwhile, fiscal policy in Europe is likely to be supportive to growth, with changes to fiscal rules allowing defense spending outside of the 3% deficit limit. In the US, we expect 1 more rate cut this year by the Fed, with it focusing on inflation a little bit more than unemployment for the time being, as hard economic data remains solid. The Bank of Japan appears committed to hiking rates and continuing policy normalization, but we expect them to hold off on moving higher too quickly. Across Asia, central banks may have more space for rate cuts and supportive measures supported by a weaker dollar. So let's move on to equities. Let's start with the US. After 2 years of strong performance, US equities have underperformed compared with developed market peers. With the recession risk reduced by the May 12 China-US trade agreement, we have seen some rebound in US equities in the second quarter. In the near term, the US market could still face some resistance due to margin compression from weaker economic demand and also higher tariffs. Investors should balance near-term headwinds with long-term investment objectives. In the longer term, the investment thesis for US equities remains strong, given their high return on equities, i.e. being more profitable, and also faster long-run earnings growth potential linked to secular themes in technology. High-quality companies are also in a strong position to weather through policy challenges. We do think investors should look to broaden their equity allocation across the world, but this does not mean eliminating positions on US equities. What about international equities? The shift towards non-US equities have been driven by heightened uncertainties on US trade negotiations, a weaker dollar, and also specific themes in international markets, whether it's in Europe or in Asia. European equities have been the top performer amongst developed markets year to date. This was helped by attractive valuations and also more proactive fiscal policy in the region, especially when it comes to national defense spending. In China, recent macro data suggests that the economic growth outlook is reasonable but not spectacular. But again, the US-China tariff de-escalation suggests that global trade tensions may have peaked. Meanwhile, AI development continues to be a core theme for Chinese equities. For Japan, while there are some questions over the near-term outlook of corporate earnings, the long-term corporate reform remains intact. This is still a multi-year positive for Japanese equities. We see active sector and stock selections to be the key in international equity investing. In some markets such as Asia and Europe, high dividend strategy can also help investors to enhance income generation. And beyond the international diversification of equity allocation, we see income to be another really core component in portfolio construction. Changes in US policies have led to market volatilities in the first half of 2025, and therefore income generation is going to be crucial for portfolio resilience. Fixed income is a typical familiar asset for adding income and diversification, but we do see other good alternative sources. For example, equities can be tailored to generate income, with high dividend equities, as we mentioned earlier, in some cases providing a better return and volatility combination than the passive benchmark in equities. In addition to stock dividends, covered call strategies using option overlays can also help to enhance income in a volatile equity environment. In addition to public markets, alternative assets such as infrastructure, real estate, and transportation offer consistent yields while reducing overall portfolio volatility. Amid policy and economic uncertainties, integrating income-oriented asset classes into portfolio to us is essential. On the topic of income, we can't avoid talking about fixed income. And fixed income assets continues to play a really critical role for investors. The US fiscal outlook could impact the long end of the yield curve, requiring duration risk management. Sustained high level of fiscal deficit in the US could lead to investors demanding a higher premium in US Treasury yields, and that could be reflected more in the long end of the yield curve. While the US economy may experience some slowdown, the outlook for US corporate credit sector remains stable. Meanwhile, we see room for further US dollar depreciation, which could benefit international fixed income, including emerging market bonds. Developed market and Asian central banks could cut rates more aggressively than the Fed, offering additional opportunities to investors. To conclude, it's clear that the second half of 2025 requires a keen understanding of the TUF environment, trade policy, unintended consequences, and also fiscal discipline. Diversification, income generation, and active management are the key ingredients for portfolio construction. Thanks for listening. If you enjoyed this podcast, please share this with your friends and colleagues, and also consider subscribing. You can find our mid-year outlook on our JP Morgan Asset Management website or from the JP Morgan Asset Management Market Insights app. If you have any topics you'd like us to cover in the future, please reach out to your JP Morgan Asset Management representative. I'm Tai Hui. I'll see you in the next episode to discuss what's on the investors' minds.
This content is a general communication being provided for informational purposes only It is educational in nature and not designed to be taken as advice or a recommendation for any specific investment product, strategy, plan feature, or other purpose in any jurisdiction, nor is it a commitment from JP Morgan Asset Management or any of its subsidiaries to participate in any of the transactions mentioned herein. Any examples used are generic, hypothetical, and for illustration purposes only. This material does not contain sufficient information to support an investment decision, and it should not be relied upon by you in evaluating the merits of investing in any securities or products. In addition, users should make an independent assessment of the legal, regulatory, tax, credit, and accounting implications and determine, together with their own financial professional, if any investment mentioned herein is believed to be appropriate to their personal goals. Investors should ensure that they obtain all available relevant information before making any investment. Any forecasts, figures, opinions, or investment techniques and strategies set out are for information purposes only based on certain assumptions and current market conditions and are subject to change without prior notice. All information presented herein is considered to be accurate at the time of production, but no warranty of accuracy is given and no liability in respect of any error or omission is accepted. It should be noted that investment involves risks. The value of investments and the income from them may fluctuate in accordance with market conditions and taxation agreements, and investors may not get back the full amount invested. Both past performance and yields are not reliable indicators of current and future results. JP Morgan Asset Management is the brand for the asset management business of JP Morgan Chase and Company and its affiliates worldwide.